We're live.
We are we are live. Hey, Paul, how are you?
Good, Greg. How you doing?
Good. So today we're talking about repositioning assets from the sale of an appreciated asset, right? And what the options and choices are, and why this can be valuable to people, right?
That's right. You always talk about flexibility, right? Flexibility on the type of assets sold, and then use a DST for that. Flexibility on the investments in the trust, and then flexibility on the distributions the note holder takes. Today, we're focusing on the investments within the trust. So diving right into it, and just so everybody knows, we'll take some questions at the end. The chat box is open, so just type them in there. We'll get to them at the end. But let's go into it, Greg. So, excuse me, we always start with a DST overview. So Deferred Sales Trust, legal, proven, IRS tested tax strategy designed to help sellers of any highly appreciated asset sell that asset, defer the taxes owed in the year of sale, and then the key part, flexible investment options. So risk-free setup, as everybody knows. We have the consultation, the attorney call, the investment call. We go through the process, and again, if the deal falls apart, whatever it may be, we work on a contingent basis, so nothing due to us. So 3-member fiduciary team within the Deferred Sales Trust, our tax attorney who sets up the trust structure itself, our financial advisor who coordinates the investments that the note holder wants to be in, and then of course Greg Reese serves as the trustee for the trust itself. So diving into the investments. So we always talk about the investment flexibility, Greg. Please tell the people more about what are the options when reinvesting DST proceeds.
Thanks, Paul. So, really the important thing to consider here is that, you may be selling real estate, you may be selling a business, you may be looking at what am I going to do in the next chapter of life, right? So having the ability to be flexible about how you reposition assets. So if I'm selling real estate, do I have to go back into real estate? No. If I'm selling a business, what am I going to do? So it's nice that you have the flexibility to reinvest your money so that it accomplishes the objectives that you set forth for yourself, whether it's income, whether it's growth, maybe it's a combination of the two. The most important thing to remember with the DST is there is no limitation or restriction on what the proceeds of your sale can be invested into, except that you have to approve it. So it's a very, participatory exercise where, we evaluate what your goals are. We evaluate what you're kind of used to investing money in, and we try to tailor and create a program where it's going to achieve the objective. So if it's income, it's growth, it's both. There's really no restrictions. So, for example, you could be in a more widely diversified portfolio of stocks, bonds, ETFs, other investment strategies in the traditional markets. You could also explore outside alternative investments such as active real estate, hard money lending, maybe dabble in crypto, who knows? But there really is no limitation or restriction on what we can do. It's just a process of identifying what are your goals and what is the proper, investment strategy to meet your goals. It's kind of that simple.
Yeah, and when we talk about kind of the 3 lanes we operate in, to add to that, we talk about exit strategy. You're selling a business, you're selling crypto, highly appreciated asset, you're looking to diversify, lower your risk. We also talk about 1031 alternatives, right? And so, we have a lot of clients, Greg, and feel free to talk about that a little bit, is they love real estate. And so they use this as a 1031 alternative. They want to go back into real estate. One of the misconceptions is, well, do I have to pay the tax to reinvest in the real estate, or do I use a 1031? So let me ask you that, Greg. If you want to buy investment real estate within a trust, do you have to use a 1031?
Probably the simplest way to sort of explain this for most people is to think about this as though the trust is similar to like a self-directed 401k plan. So the 401k concept means that your money is in a tax advantaged environment. You're not paying taxes unless and until you actually want to draw some money out for your own, needs and purposes. But within the bucket, there's really nothing that you can take off the table for consideration. So you could use tax deferred money to buy an active real estate investment, for example. You could use it. You could use the money to invest in pretty much anything you want to. So no, you don't have to pay taxes if you want to invest in something that may not seem as traditional. Like I want to buy an apartment building, I want to buy a commercial building, something like that. The trust can partner with you essentially, so that you can engage in that type of investment. So it's it's amazing how flexible this is, and you can shift from one position to another. So think about your 401k concept again. It's like, if I want to get out of this mutual fund, or I want to get out of this investment and I want to redeploy my money into something else, it's no different than if the money is sitting in your 401k plan. You simply redirect the money where you think it's going to best produce what your objectives and goals are.
Yep. And then on the investment side, Greg, for folks that are, let's say, they want to talk about quarterly reviews or annual reviews, what is our standard process for that? Do we talk to clients every 6 months, every year? How often do we stay in touch with them?
So, typically we're very flexible. I mean, we kind of have a model where we try to do quarterly reviews with every client, where we report back on the progress and the performance and everything that's happened, make sure that they have, easy access online, because we provide transparency for all investments that are ultimately made and approved by them. And so you can see it anytime you want, but we're going to do reporting on a quarterly basis. If clients want to do it more frequently or less frequently, that's fine too. We operate around what your desires and your goals are. So that's, we'll figure it out together.
Yeah, perfect. So going into just one quick case study, just as a template example. So this is our sample investment structure. So this is, let's say, a real estate investor who used the DST to defer the tax on the sale of a property, but they want to dive back into investment real estate. So on the left side, if you want to kind of walk them through, I'll walk them through on the left side. So in network investments, guys, everything overseen by the financial advisor member of the team. So, ETFs, REITs, bonds, stocks, managed funds, et cetera. But the beauty of the DST, back to that word flexibility, is the out-of-network side. So Greg, if you want to walk people through what a sample out-of-network real estate investment looks like.
Yeah, sure. So thanks. So again, this is a nice kind of illustration of the flexibility of investment choices that you have available to you. So, some people go out of real estate and they like real estate. It's served them well. They've made wealth doing that. And at some point they may want to reinvest back into that sector. Well, the beauty of the DST versus, say, a 1031 exchange is you can park your money and wait for the right investment at the right time. There is no limitation or restriction on timelines or amounts or anything like that. So, if you think that the real estate market is overvalued, but you'd like to get back in, and maybe a couple of years from now, it's going to be a better time for you to jump back in. You've got that kind of flexibility. So when we talk about in-network and out-of-network, and again, just to reiterate what Paul just said, in-network is just kind of our term for all of the universe of investment options that are available and can be managed by a licensed professional investment advisor who will be a member of our team, right? Out-of-network is just our term for saying, hey, my investment advisor doesn't manage real estate investments that are active, right? That's something that you would make decisions on, and we can deploy money in either direction. So, you might want to buy an apartment building. You might want to do hard money lending. You might want to have an opportunity in a private equity or a private placement type of investment that maybe the investment advisor doesn't particularly oversee and operate in. You really have all options on the table. We just need to work together to make sure that whatever you want the trust to invest into is complementary to your objective. So if it's an income objective, if it's a growth objective, or if it's just, I just like the sector, I want to get involved in it, then we just talk about it together, and then we deploy to make sure it works for you.
Yep, that's it. So flexibility is the kind of key word, and that's really the end of this webinar. But anybody have any questions for us? We're happy to answer those. If not, a lot of information that we have on our website as well. You'll get a presentation with the recap to this webinar that goes out. So any questions, let us know. But back to the key points that Greg made, a ton of investment flexibility on the DST side. You're not locked in. When we talk about 1031s, we talk about Delaware's, there's very limiting factors, 45 days, 6 months. We've talked about those things, but on the DST side, you have a ton of flexibility. So any questions, please let us know. Feel free to reach out. Any final thoughts, Greg?
No, it just a pretty simple conversation today. People like to know that I may be getting out of a particular asset class, which is, not well diversified. This gives you an opportunity to sell that asset, defer the taxes, put that money to work directly for your benefit, and have really a universe of choices as to how to redeploy your money. It can be more diversified, it can be more liquid, and a lot of people really like that. So that's the key.
Perfect. All right. Well, thank you everybody for joining us. Appreciate Greg for all the explanation, and then we'll see you on the next one.
All right. Thank you, Paul.
Thanks, guys.
Great.